What is the single greatest, yet most hidden threat to your long-term wealth? It's not a market crash or a bad stock pick. It's a mathematical certainty called non-ergodicity. Today, we're diving into a really elegant solution to this problem, all outlined in a framework called the Freesurfer, growth that costs nothing. So, how exactly do we navigate this hidden threat? Well, our journey today is going to take us from the fundamental problem that quietly erodes wealth to the conventional solutions investors rely on, and finally to a very rare species of asset that fuses attack and defense in a truly unique way. All right, let's start right there with that central threat. This is one of those concepts that once you really get it, it changes how you view every single investment decision you make. The question here isn't just about losing money, not at all. It's about the path-dependent nature of your returns. See, the sequence of your gains and losses matters immensely. Now notice the critical asymmetry here. A loss permanently impairs your compounding power in a way that a gain just doesn't. The source material uses a great analogy. It's like an avalanche that destroys the path back up the mountain. You can't simply retrace your steps. The damage is mathematically irreversible. So, how do investors typically fight back against this? Well, they use compounders. But as we're about to see, they are not all created equal, especially when we look inside what the source material calls bucket 3, the real wealth-building engine of a portfolio. And this just brilliantly illustrates the fundamental trade-off, doesn't it? The 3A stalwart is what you'd call a short-duration compounder. It gives you your capital back as you go. The 3B growth engine, on the other hand, is long-duration. It asks you to trust management to reinvest it wisely, and that, of course, introduces significant execution risk. But what if this whole trade-off was just a false choice? The source material identifies a third, much rarer species that completely defies this conventional thinking. And it's not simply a hybrid of the two. No, it operates on a different plane entirely. It represents a fundamentally different approach to creating wealth. Now, this is the game changer. It combines the stability of that stalwart with the growth of the engine, but with a critical twist. It gets that growth component without ever having to invest for it. Let's take Visa. It's a classic 3A stalwart, right? A toll booth on transactions, returning cash to shareholders. But it also benefits from this massive free B component, the global irreversible shift from cash to digital payments. Visa doesn't pay for this wave. It simply rides it on the surfboard of its duopoly network. Very few companies meet all three of these criteria. The growth has to be a direct subsidy to the top line, not just a cost reduction, and it has to be captured almost effortlessly. Think about it. Every single transaction that moves from cash to digital is new revenue for Visa, and there's no truck to buy or warehouse to build. So this free growth, it doesn't just add to the business, it actually multiplies its power. Let's take a look at how this creates this incredible feedback loop that supercharges the whole compounding process. This right here is the engine. The B feeds the A, and the A accelerates. The source uses this fantastic metaphor. A stalwart walks on a flat floor, but a free surfer walks on an escalator. Same effort, but double the elevation. That free B is the escalator just rising up beneath its feet. Okay, so let's connect this all the way back to our initial problem, that devastating volatility tax. Now, Nassim Taleb famously proposed the barbell strategy as a defense against this very threat. What the Freesurfer does is, well, it collapses this entire strategy into a single instrument. The predictable cash flow from its stalwart nature, that's the A component, that's your shield. It absorbs the drawdowns. And the free structural growth from the secular wave, the B component, that's your sword. It provides that asymmetric upside. It minimizes that volatility tax because the shield contains the fall and the sword accelerates the recovery. And what's so crucial is that the upside comes without a premium and without the execution risk tied to a typical growth engine. The A prevents the catastrophic fall, and the B ensures the recovery. So the big question is, where can we actually find these rare assets? And, if they're so perfect, aren't they just priced to perfection by the market? The source identifies 5 main candidates, and they all live in financial infrastructure. You can think of them as the toll bridges of the global financial system. Notice how S&P Global and Moody's ride the wave of expanding capital markets, and they're protected by a regulatory duopoly. Or how MSCI benefits from that massive secular shift to passive investing. Now, this perfection isn't without risk, of course.
Things like regulatory changes could always threaten the moats of these businesses.
But here's the key insight. The argument is that the market systematically misprices these assets. See, analysts often value a Freesurfer just like a high-quality growth engine, but its growth carries far, far less execution risk. This is the gratuity, a durable, costless growth stream that should, in theory, command a much lower discount rate, and that makes it less susceptible to that very volatility tax we started with. In fact, this source suggests that if you adjust for this lower risk profile, you could increase a Freesurfer's justified present value by something like 15 to 25%. And that implies that even at what looks like a high multiple, the market may not be fully pricing in the quality and durability of its free growth. And this quote just perfectly captures the essence of owning a Freesurfer. The structural wave does all the heavy lifting for you. It offers one of the highest quality adjusted returns for arguably the lowest attention cost of any asset class out there. It's a powerful question for any long-term investor. To explore these investment strategies further and discover more from the collection, visit the website averagingup.com.